Picture your credit card bill for a second. You owe $1,000. And right there at the bottom, in friendly little letters, the card company offers you an easy way out, a minimum payment of just $35. Pay that and you're all square for the month. And honestly, it feels generous. Almost kind. $35 instead of a whole thousand? What a relief. So you pay the minimum, you breathe easy, and you get on with your life. But that tiny, friendly little minimum payment is quietly one of the most expensive traps in all of personal finance. Pay only that, month after month, and your $1,000 balance can take well over a decade to clear and end up costing you far, far more than $1,000. And Americans are caught in this trap on a genuinely staggering scale. By the end of 2025, U.S. credit card debt hit a record $1.28 trillion. At the highest interest rates ever recorded, with more people than ever paying only the minimum. So, why does the helpful little minimum payment cost you so very much? And why does your bank quietly, secretly love it when you choose it? To see the trap clearly, we just have to follow the money, one swipe at a time. Let's start with what a credit card really, truly is. Every single time you swipe it, you are not actually spending your own money. You are borrowing the bank's money and quietly promising to pay it all back. Now here's the part the banks don't exactly advertise on a billboard. If you pay back the full amount by the due date, you usually pay zero interest. It's called the grace period. And used that way, a credit card is basically a free, short-term loan. A genuinely great deal. But if you don't pay in full, if you leave even a little bit behind, then that leftover balance revolves. It quietly rolls over into next month. And now the bank starts charging you interest on it. Every single day. And that one little flip from paying in full to carrying a balance is the entire ballgame. It's the whole difference between the card being a free tool and a brutally expensive trap. And the minimum payment is exactly what keeps you on the wrong side of that line. To really understand the trap, you only need one number, the APR, the annual percentage rate. It's simply the yearly interest rate the card charges you on any balance you carry. And credit card APRs are brutally, eye-wateringly high. As of 2024, the average sat at a record of roughly 23%. To put that in perspective, a typical home loan is around 6 or 7%. Credit cards charge 3 to 4 times more, and it has been climbing relentlessly for years. As the Federal Reserve cranked up its rates through 2022 and 2023, credit card APRs marched right up alongside them, all the way to the highest levels ever recorded. So, what does 23% actually mean for you in plain terms? It means that for every $100 you carry for a year, you owe about $23 on top, purely for the privilege of not having paid it off yet. So now, back to that friendly little minimum payment. It's usually tiny, often just 1 or 2% of your balance, plus that month's interest. On a $1,000 balance, that might come to around $35. But just watch where those $35 actually go. At 23% APR, the interest alone on $1,000 is roughly $19 that month. So, out of your $35 payment, $19 instantly vanishes into interest, and only about $16 actually pays down what you owe.
$16.
Off a balance of $1,000. You've made your payment, you feel responsible and grown up, but your actual debt has barely even moved. And the bank designed that minimum to work exactly that way on purpose. Because here's the thing, the minimum payment is not calculated to get you out of debt. It is very carefully calculated to keep you in it, paying just enough to cover most of the interest and almost none of the principal. And here is where the whole thing turns genuinely vicious. Compounding. The interest that you don't pay off simply gets added onto your balance. So next month you end up paying interest on your interest. Pay only the minimum on that $1,000 balance, and it doesn't take a few months to clear. It takes years. By many estimates, well over a full decade of steady, faithful monthly payments. And across all of those long years, the interest piles up so high that you can end up paying more than $2,000 just to clear an original debt of $1,000. You paid for your purchase twice over and handed the entire difference straight to the bank. A small balance, paid only at the minimum, doesn't really shrink at all. It just sits there, quietly compounding away, like a meter that keeps right on running while you sleep. So now, let's flip all the way around to the bank's side of the table. Who, exactly, is their most profitable customer? Well, it is definitely not the person who pays in full every month. That person pays zero interest and the bank barely makes a thing off them. No, their absolute favorite customer is the revolver, the person who carries a balance, never quite pays it all off, and faithfully sends in the minimum month after month. That one customer is a steady, reliable, beautiful river of interest payments, year after year after year. In fact, the industry's ideal customer is someone who borrows a lot and then pays it back slowly, more or less forever. Profitable, reliable, but never quite drowning. And the minimum payment is the precise tool that keeps them parked perfectly in that zone. So when your monthly statement gently, helpfully suggests that you just pay the minimum, understand clearly that this is not friendly financial advice for your benefit. It is very politely a sales pitch for theirs. And this very same trap has now snapped shut on the entire country, all at once. American credit card balances have absolutely exploded over the past few years. After dipping down during the pandemic, the balances came roaring right back. From around $800 billion in 2021, they climbed year after year after year to a record $1.28 trillion by the end of 2025. And here's something even more troubling. The share of people making only that minimum payment has now climbed to its highest level in years. More and more households paying just barely enough to stay afloat, and absolutely no more than that. And at the very same time, the number of people falling behind entirely, actually missing their payments altogether, has been steadily rising. So the trap isn't only expensive anymore. For a growing number of people, it is genuinely starting to close. But now for some genuinely good news, because this trap actually has one very simple key. And honestly, the banks would quietly prefer you didn't think about it too hard. Rule number 1, whenever you possibly can, pay the balance in full. Do exactly that, and the grace period kicks in, the APR never even touches you, and the card snaps right back into being a free, convenient little tool. And what if you genuinely can't pay it in full this month? Then pay as much over the minimum as you possibly can manage. Because remember, almost every single dollar above that minimum goes straight at the principal. It is the fastest, cheapest way there is to shrink the balance. And that one simple move flips the entire game on its head. Paying a little extra doesn't just chip away at the debt, it actively starves the compounding engine that the whole trap quietly runs on. So here's the real lesson, hiding inside that friendly little number at the very bottom of your bill. The minimum payment was never, ever designed to help you get out of debt. It was carefully designed to keep you comfortably and very profitably in it. A credit card is a genuinely brilliant tool if you pay it in full, and a brutally expensive loan the very moment that you don't. And the entire difference between those two worlds comes down to one thing: whether you pay it off or you just pay the minimum. So the next time your statement smiles up at you and gently suggests that you only really owe $35, just remember exactly who that minimum payment was truly built for, and then pay more.